to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who has worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer and independent advisories. Sitting across from me, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and Head of Research at analyst firm Aegis Equities, Head of Quantitative Strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, which are a multinational asset management company. And of course, for more information, please check out our people section at www.nucleuswealth.com. Yes, so hello and welcome to yet another instalment of Nucleus Insights. And today's webinar is entitled World Valuation Roundup. So we thought, obviously, given the last couple of months has been a fairly tumultuous time in global markets, and there's been plenty of political persuasion as well, no doubt. So we thought that it might be time really to take a step back from the day-to-day ups and downs and the finer minutiae of world markets, and instead take a step back and look at it from a more holistic perspective, given some obviously historical data that we've got, and then sort of putting it into a broader picture and giving you guys an opportunity to have a look at the way that we look at things as well. So rolling into it, we've got today we're going to look at currencies and purchasing power first up. Then we're going to overlay that into bonds and what's happening in global credit markets, both currently and overviewing that historically. We're going to look at the state of global shares. And then finally, of course, zoom in on how we find value in what's potentially an overvalued world and how we bring that into play every day at Nucleus Wealth. So I'll hand over to, and also welcome Damien Klassen, of course, our Head of Investments. Welcome, Damien.
Thanks, Jim.
And we'll jump right into it. So currencies, mate. Aussie dollar still expensive there. You might want to just walk us through this graph. And actually, just before we jump in, for those that are listening on an audio channel or on a podcast, feel free to get in touch at webinars@nucleuswealth.com. If you'd like a slide pack as well, we've got those available. So we'll jump back into it then. So g'day, Damien, and what can you tell us about the AUD?
Yeah, sure. And I'll talk through these for people on the podcast. So I've got a chart up there showing what's called purchasing power parity, and it's just sort of got a list of the OECD countries and showing there that Australia is sitting right at the top of that, in terms of being overvalued, and looking at what you can buy in other countries. So basically, what it is that it takes a purchasing power parity, takes a basket of goods in a whole bunch of different countries, and then says, well, if you had to buy that with Australian dollars, what would it cost you? And then it uses that to say, well, ideally it'd cost you the same amount of money to buy that in whatever country, and relative to wages and these types of things.
Okay.
So that you can then say, well, for an average person to buy a basket of goods, there's a what's called a Big Mac index, which is a sort of a bit of a
can of Coke index as well, I think as well. Yep.
Yeah. What's good with the Big Mac index is that it's sort of and it was sort of initially a lighthearted way, but it's actually quite a good indicator in terms of it being there's a bit of services that goes into it. So you need the employment to actually make the burger. There's some there's meat in there. There's bread. There's rent that goes into the store. So it's sort of it is lighthearted, but it is a microcosm of a bunch of things that sort of go into producing a product and what it costs between relative countries.
Yeah, sure.
And why Australia is so high on that list is because we've been through these two big booms, big housing boom and a big mining boom before that, and the mining boom was probably the bigger one in terms of needed to push the Australian dollar up because the rest of the world was saying, hey, we need these commodities. We don't want you out making coffees and doing financial services. We want you in the mines, digging up as much of this stuff and supplying it to China. And so they basically had to bid up the Aussie dollar to convince people in terms of the to go out and do that.
Sure.
And then as that's come off, though, now it's a matter of saying, well, as the tide goes back out again, is that the Australian economy needs to hit a stage where if we're not expecting a never-ending mining boom, and we're not, and we're not expecting a never-ending housing boom, and we're not, is that we need to reach a level where a multinational company can look at Australian salaries and say, I need to hire somebody in my legal department in the Asian region. At the moment, they're still sort of saying, well, Singapore's a bit cheaper or Hong Kong's a bit cheaper. I'll hire somebody there. We need to be at the stage where people start to treat Australia as equally likely or even start hiring people preferentially in Australia.
Okay, sure.
So we've done a fair bit on the currencies in the past. I'll probably refer people back to that. But I guess just the broad overview was that, look, Australian dollar is still expensive. So our longer term view is that you want to be investing in offshore assets.
Okay.
Because as the Aussie dollar falls, those assets overseas will be worth more.
Okay, fantastic. All right, very good. And then moving then from currencies into bonds. So what can you tell us about the current state of bonds versus the historical averages?
So I've got a chart showing which is it's actually got the US just because there's a nice long time series you can pull out for the US, and what it's showing is that we've been through this long period of, and this is sort of showing about 130 odd years. It's showing that most of the time, interest rates were sort of between that 4 and 6% or 3 and 6%, and that we went through sort of some quite low periods through the Second World War, where we hit sort of that where the US sort of hit 2.5%. It then skyrocketed higher in the 80s with inflation and things like that running out of control, and sort of hit the 15 to 20% level.
Yep.
And now we're back to these all-time lows, and we've recently bounced off the bottom. But it is worth remembering that regardless of the fact that interest rates are up relatively significantly over the last little while, from sort of the 2 and a bit percent to high 2%. In terms of the overall scheme of it, they're still extraordinarily low.
Sure.
And it's even worse in Europe, which we'll jump onto in a minute. But I think just the big picture from bonds is bonds are very, very expensive.
Yep.
With a long-term view. Having said that, there will be opportunities to, making money in them. But it's also worth noting that some of the returns you get quoted on bonds are often sort of these 10-year bonds, assuming that you're selling and buying 10-year bonds from year to year and making profits and things like that, which isn't usually the way most investors would treat bonds. Most investors, we treat it as a bit of you give somebody a bit of what we call a bond ladder, where I've given you some 1-year bonds and some 2-year bonds and 3 years and all that type of stuff, and your 1-year bonds roll off, and then we just stick you back on at the other end of the ladder.
Yep, sure.
And so I tend to treat bonds as something in the portfolio where they're there as my safety mechanism, provide some ballast and stabilise your portfolio, and then when things really go badly, the bonds often go up in value, and it's a chance to sell those and use that to buy undervalued equities.
So the war chest, as it were.
Absolutely.
Okay, sure.
But it is worth noting that if your bonds, it is quite hard to, especially if we're investing in government bonds where governments have the ability to print the money, it's quite hard to lose money in nominal terms, because your bond has an expiry of at $100 when it expires.
Yep.
The fact that interest rates have risen or fallen affects the bond price right now, but you're still getting $100 at expiry, and there's a fixed coupon on that, and so it's sort of a while bonds are very expensive, there's not as much danger in terms of losing. There's an opportunity cost in terms of I could buy some bonds at 3%, especially 10-year bonds, and maybe interest rates go much higher and the value goes lower. But if I'm holding that to maturity, I'm still getting my $100. I'm still getting my 3% yield over the time frame. I'm not really losing money. It's more of an opportunity cost. I could have made
And hence, it's naturally just a defensive asset and used in that purpose in our portfolios.
Yeah, absolutely. And the other thing bonds really do help you for within a portfolio, an asset allocation portfolio, is as many people would have noticed that as interest rates have come down, and if people are living off interest that's being generated by the portfolio, that hurts.
Yep.
And the cash rates happen immediately. So if I've bought a 10-year bond at a 5% yield a few years ago, I'm still getting that 5% yield all the way through till when it expires.
Yep.
So bonds, you still eventually, you need to go back, and that bond ladder, you need to stick something on the end, and you need to buy new ones and things like that. So you still are exposed to interest rates, but it does lag that effect. So that whereas if you've got all your money in cash, and cash rates suddenly fall 1%,
you're going to feel it tomorrow.
Away.
Yep,
Exactly.
That's right. Okay.
Bonds, you'll get that over a 4 or 5 year period on average.
Yep.
Depending upon the duration of your.
And then hence you can diversify by buying different time bonds, different length bonds.
Yes,
yep.
Absolutely.
Okay, very good. So we'll whilst we're on the topic of bonds, we'll jump into a global perspective by country here for the majors.
Yep. So this is what we've got now is a chart just showing a mixture between. On one axis, I've got what's called the bond curve steepness, and what this represents is the 10-year bond yield versus the 2-year bond yield, and without sort of going too much into the detail of it, the difference between the two is partly what we call term premium, but what it really indicates is, or what's most well known for indicating is recession type issues. So when you get this really flat bond yield curve, where the 2-year rate, percent you get on a 2-year rate is very similar to the percent you get on a 10-year rate.
Sure.
It's indicating that the markets are expecting recessions or poor economic growth, and when you get quite a steep one, markets are expecting a stronger EPS growth.
Okay.
Stronger economic growth.
Economic growth. Okay, yeah, sure. And so, given that information, whereabouts? So obviously we've got Japan there on the far left.
Yeah. So most of the countries are sort of down there as quite flat. Then I've got on the y-axis I'm showing the change over the last 12 months, and so Japan, at the bottom hasn't changed over the last 12 months, and so it's basically going well. People aren't expecting a very good outlook, and that hasn't changed. You look through Canada, the US, and the UK, and we're seeing that bond is still relatively poor in terms of relatively flat bond yield curve. But it is improving. So expectations are in those countries that conditions are improving. Australia is sitting right down the bottom, so not as poor in terms of bond yield flatness of the yield, but certainly interest rates, the 10-year rates have been falling. And so the question for us is, in Australia, are we out of sync with the rest of the world? And our view is yes, we are out of sync with the rest of the world, which is why one more reason for moving offshore.
Okay, fantastic. And anything else to add on that one? I can see a couple of outliers there in Italy and China.
Yeah, well, so Germany, Italy, and France are interesting in that they have a relatively steep bond yield curve, but they've got negative rates at the short end, and so it's really extraordinary is the word, isn't it? Have to keep coming back to that. Is we just need to keep remembering that these are extraordinary times that you can have government bond yields that are negative in countries which literally means people are giving money, expecting to get back less and thinking that it's a good deal. People will go out and buy these bonds and expect to get less money than what they put in.
That's remarkable, isn't it?
Yeah.
Yeah.
and we lose track of it, but just taking that step back these are extraordinary times for bonds, especially overseas.
Okay, sure. Moving on to another graph here, and this one's quite telling actually. So let's jump into the X and Y's on this one, just for those listening.
Yeah. So what I'm showing here is at the 2-year level. So if you invested in a bond over 2 years, what's your expected return on a real and on a nominal basis? So what I mean by real is adjusted for inflation and just the latest inflation number from these countries.
Yep, sure.
Because the issue is, if you're getting a 1% yield on your bond, but inflation's 3 or 4%, then you're actually losing money over the time frame. And traditionally, that doesn't happen. Usually, bonds trade at a premium over inflation. That's the whole idea of this.
The point of them.
Exactly. And that's not happening at the moment. And there's a whole range of countries where we have negative yields, and I've sort of broken it into sort of three bits. We've got one sort of part where you do have Germany, France, UK, Italy, those types of countries which are deeply negative real yields, and for some of them negative in terms of nominal yields as well. So this is sort of the extraordinary component. At the more normal end, I've got China, which is probably would be a little bit higher on the graph in a more normal point of view, but there's sort of real yields of almost 2% and nominal yields of almost 4%. So it's sort of what you'd expect in a more normal one. And then sitting in the middle, we've got three countries: Australia, United States, and Canada, which are sort of transitioning. And so the question here is, US and Canada have been moving up the scale, and Australia's moving back down. And the question is, will Australia move into this negative territory, or at least back in further into, certainly on a real perspective?
Yep.
Will we move further as we need to get this adjustment to get the currency lower, to get what's going to be the cause, and if there is any shakeout in the housing market. And so our view is that, look, bond yields are we're not normalising anytime soon. We're similar to what the RBA keeps telling us. But having said that, they've been pushing it out. We sort of feel as if we've been very much on the look. There still are potentials for rate cuts if we don't see the growth pick up, and we're not really seeing it pick up, and if the housing boom slows off, and there's a number of ifs there that could easily see rates get cut further from where they are today.
So potentially lower for longer, feel lower for longer from the RBA, perhaps.
That's right.
Okay, very good.
Okay.
And anything else on that one? We've obviously got China in the far corner. Is there sort of any note there? I know we've quite a few listeners love a little bit of China rhetoric. So,
Look, the thing on China is, it's worth noting that the situation is not the same in China as other countries. Is that they've been keeping rates low, which has basically been a transfer from the retail investor to corporates over there.
Sure.
So the idea is that in most other countries, there's especially somewhere like Australia, the retail, the average consumer is the lender. They're out there, lots loading up on mortgages in a big way.
Yep.
In China, it's a little bit different in that it's the corporates that are the lenders,
and I guess state level as well.
Yeah,
yep.
and it's generally the consumers that are the consumers are the lenders, and the state the corporates are the borrowers.
Sure.
And so if you artificially push rates down, which is what they've done, you're effectively saying, well, I'm taking money away. I'm taking interest payments away from the consumer sector and giving it to the corporate sector
Gotcha.
to help them, and the reason for that is to keep the CapEx boom going and keep everything pushing along.
Okay.
So, they've got different questions in that when rates rise, it actually flips things around a little bit, actually pushes back a little bit towards the consumer in a bit of way, whereas other countries are the opposite.
Okay, sure thing. All right, very good. So that's bonds covered off. Yeah. We might jump into probably slightly more exciting parts of the world for our listeners and viewers, but of course we'll jump into in equities and stocks in general. So
so I'm going to start with stocks. Stocks I've got a bunch of different charts here, which I want to explain in terms of where we see the markets, and they are showing some very different things. So one of the ones which one of the more bearish charts in terms of valuations is price to sales. Now this is a pretty crude measure in the end, but it does give you a decent longer term perspective, and that's showing we're not far off our all-time off our recent highs. So we've got certainly for the last 15 years. So we're well above where it peaked out before the financial crisis.
And that's quite interesting, isn't it? That they really are all new highs. Yep.
Yeah. So that's on that basis. Look, stocks are certainly expensive. There are some complications, and we'll move into that as we go on. And a lot of that is lower interest rates, higher margins, and one other thing, and lower tax rates.
Sure.
But let's step into that, and we'll see some differences. So So if we'll flick so that's that one. The next one is and I'm calling both these. So these are sort of deep value ones. So we look at price to sales, which gives us this longer term look about you've made $1 worth of sales. What's your share price on average, and how does that match up? And then this one's your price to your book value. So what's the market paying for it versus what the accountants say it's worth and this is sort of like gives you a little bit of safety margin type thing, and it's saying, well, if worse comes to worse, what can I sell the assets for?
Yep. So essentially, what's physical capital and intangible capital versus hubris, perhaps.
That's right. And so it doesn't look as expensive there. We're below the peaks of 2007. There's in a longer term sense, you're sort of saying, well, it's above average, but it's not miles above average, and it's well off its peaks. So it looks like from a price to book perspective, you could go higher.
Sure.
The issue I do have with these price to book charts is that there's two ways to get a lower price to book ratio. Your price can fall, or to get this right, it's rise. Yeah, so your price can rise, or your book value can fall.
Okay.
And so, if the question for these ones is, there have been some relatively significant accounting changes over the last 15, 20 years.
Right.
And generally what's happened is those accounting changes have meant that you can now write off, there's now more impetus to write off assets that are sitting on your balance sheet.
Yeah, okay.
And so there's more tests that say, and you can't put them back on, or it's very hard to put those back on. So it used to be that under accounting rules, you'd write down your assets, and then something had happened and you could revalue it back up and things like that. And there wasn't this impetus of every year you've got to really assess these assets. You could just leave the assets on there and go, well, I bought them for that, and there's not a big reason to change it, so I'll just leave it on there.
That's fascinating.
Whereas now there's a lot of rules around what you have to do and when you have to write the assets down. So what that means is you get more write downs, which means your
book value is getting hammered.
Yeah, your book value gets, yeah, that's right. So so there are distortions within this graph that aren't sort of that mean that over a longer time period, it's not as comparable as you think.
Okay, sure. All right, no problems. Looking at then the impact of interest and the interest expenses.
Yeah, so sort of taking up, basically going up the balance sheet. Sorry, coming down the profit and loss. So we started with sales and had a look at their sales, and then we say, well, what happens if we look at earnings before interest and tax? So this is a similar type of ratio. So it's basically the price, and we're using the enterprise value just for complicated reasons, but call it the price. The price versus the earnings you have before you've paid any interest and before you've paid any tax, because we know that those have changed, and we want to see
the raw figure.
The raw figure. Yeah.
Okay, sure.
And so we can see that still very expensive on that measures. We're still again well above the 2007 highs. Not very far. We're not very far off our peaks. It's been relatively stable the last few years, but it is expensive on this measure.
And that's sort of quite interesting in the sense that obviously global share markets and particularly the US have climbed in that time as well. So
yes, yeah, absolutely. And so what this reflects though, it's three things it reflects, and one is some rising margins.
Okay.
The proportion of earnings, your cost relative to your profit has changed.
Yep. Okay.
And so I've got another chart. We'll move on to that in a bit more detail. It's also that interest rates are much lower.
Yep.
So if I've got much lower interest rates on my debt, then I can afford to pay more for earnings before interest and tax. And then the tax rates are coming down. So we've obviously had a big cut in the US tax rate, and we've actually had lots of cuts all around the world. And it's a bit of a race to the bottom at the moment. And we'll show a few charts on that a bit later. But it means that we can actually afford. So this one again, look, things are expensive, but you can afford to pay more if you're actually getting more at the bottom line.
Okay, all right, very good.
And that's where the next chart sort of this is getting right down the line in terms of what you're earning, and this is showing the actual profit. I've got two measures here. One's called the next 12 months, and the other one's called the last 12 months. And this is quite a common one. We'll put in a lot of our data.
And so, just for those that are viewing it, the last is the dark blue, and the next or the forecast is the light blue. So
yeah. Yep. So what you want to do in the last, what the last 12 months is basically saying, if I look back at what the company earned over the last 12 months and compare that to the price, what do I get? The issue with the last 12 months is it's a lot more volatile, because those earnings you do get these write downs and write ups and profits in good times that pop up.
Get a bit of kitchen sinking happening, and then a few profit surprises as well, no doubt.
Yeah. So that's it's an interesting measure. That's well worth keeping an eye on that one, especially in terms of but it's better used over a longer time period because you do get these one-off, and I've got some charts later on that average that over a few years because that gives you a better view of what's going on. Because otherwise you're sitting looking at these charts going, well, it's been as low as 5 times, it's been as high as 30-something times. Now we're 20-something times. It's still all right, but the ranges are too broad.
Okay.
Then you have the next 12 months numbers, and those ones are complicated in a different way in that they're probably a much better indication of what the market's thinking because it's looking forward at next year's earnings and saying how much will I pay for a stock based on what I think it's going to earn in the next 12 months. The issue is the next 12 months numbers are pretty bad in terms of the forecast. They can easily change by 10-20%.
Okay.
So it needs to be when you're looking at these, you need to keep thinking about it's a top and a bottom. So if I think this is too high, there's 2 ways we can fix that. The price can fall.
Yep.
Or the price can stay the same, and the earnings can rise.
Can rise. Yep. Sure.
And at the moment, we've got very much that earnings rising quite rapidly.
Okay.
And particularly in the US, where we've seen those earnings, has come through. And just your impact of the buybacks and these things we're expecting to come through is going to push those earnings, higher in 2018, 2019.
Okay, fascinating. All right, very good.
So yeah, and so on that basis, so the next 12-month number is the more appropriate one. Look, it's expensive. It's not horrendously expensive.
Mm-hmm.
It's sort of a little bit below some of the peaks we saw in 2017. So the stocks are. Expensive, but relative to whereas we're looking at bonds are really expensive. They're astronomical.
Yep.
Stocks we're looking at on this basis at least and saying they're expensive a little bit. They're not right out there.
Okay. Yep. Sure.
So there are justifications, and if we see the profit growth come through, then that pulls them back
right.
to a more reasonable level.
Yep. Okay. Sure. All right. Very good. And then moving into, and you mentioned this before, but the changing in margins. So obviously, before we jump, so a margin being obviously the gross profit or the fat, the earnings. Yeah.
Earnings before interest and tax divided by the total sales.
Okay, sure.
So it's basically trying to look and see, the company sells $1, how much actually flows through to the bottom line.
Okay.
Now this is what some people would call a mean reverting series, in that over time they expect it to keep coming back to the same to an average level. The question is, I've only shown it 15 years here, and we're at we're at 15-year highs in terms of these margins at the moment. If you look back over longer periods, it's even higher than that.
Right. Okay.
And so, and we're away from the average. So the question for a lot of people is saying, well, when this series reverts, then stocks will be expensive because margins will fall back to a more reasonable level. And they're right. When it reverts, a better question is if it reverts and at what level it'll revert to. And so there's a few things that have changed. Probably the biggest one is services.
Okay.
So if you're a manufacturer, you generally make lower margins.
Yep.
If you're a retailer, you generally make quite minuscule margins.
Okay.
You're just making
so a volume. It's a volume sort of activity over a.
Yeah, you're a middleman.
Yep.
I've got one big cost on one side and a big sales on the other, and I'm just taking this small little slice in the middle.
Sure.
If you're a Facebook, for example, you make incredible margins because you haven't got very much in costs and you've got lots of revenue, and so that sort of flows straight through the bottom line. And it's not quite the same for all services companies, but services companies in general generally make much better margins than manufacturing companies.
Sure.
And so as we're sort of progressing to services companies, there's a lot of debate about, is this a services versus manufacturing, and even companies like you get, say Boeing, it was if you look at it like a 747, they used to produce 70%, 60 to 70% of all the components were manufactured by Boeing.
Sure.
Nowadays, for the 787,
yep,
it's the other way around. They produce about 30%, and
wow,
they outsource about 70%.
Yeah, okay.
And so basically, they're just collecting parts from all these other people and putting it together to make themselves a plane. And so what that means is they're doing a lot more services than what they used to.
Yeah, fair point.
So
okay,
even a manufacturer, which is notionally, still a manufacturer, was a manufacturer 20 years ago, it's still a manufacturer today, but are they doing a lot less manufacturing and a lot more
project management, I guess, in a sense.
Are they
Yeah,
a lot
right.
more of a services company than they used to be?
Yeah, okay.
And the answer is probably yes. And so the question with these margins and will they revert and when will they revert is look, they're certainly high. We need wage pressures to get them down, and we're not really seeing wage pressures. It's still very much at the margin.
Sure.
And so until we actually start seeing wage pressures, I'm not expecting these to come back. And I think there's a lot of good reasons why they won't fall as low as what they might look like. If you look at a long-term time series.
Because there's been a paradigm shift now from the manufacturers moving into these higher margin activities, essentially.
And
right.
we're just literally looking at different companies.
Okay, fantastic. All right, very good.
Taxes. Yeah, so this is I've got a graph just showing that in 1980, 50% of 50% tax rate for
that's an amazing number.
OECD corporate, and now it's 25, and that's before Trump's tax cuts.
Sure.
We've got some UK tax cuts that are still flowing through. We're in this race to the bottom. So if you are earning, if you're paying 50% of your profit away, then
your margins getting hammered.
Are lower.
That's right.
Yeah,
yep.
that's
So
right.
it makes sense.
So
rise in margins with the falling tax rate.
Yeah.
Absolutely.
So can we afford to pay a bit more for stocks? Yeah, we can. If these reverse, that's the same thing as earnings reverse. The thing is, we can't afford to pay for all these infrastructure and healthcare and all these things around the world, and we need to get these taxes to increase. Yep, that's probably right. Over the long term, the pendulum shifts and the pendulum is swinging a long way towards corporates not paying tax at the moment. That will probably swing back at some stage, but it's not looking like swinging anytime soon. I mean, we're still pushing through the Trump tax cuts. Australia's still debating about lower tax rates.
Absolutely.
Right around the world, we're years away from that pendulum swinging back. So there's probably still a few more years of taxes to fall. And the other thing to think about as well in terms of taxes is when you do get tax changes, and the Trump tax cuts have got a number of other, it's not just a tax cut, there are a number of rules changes. There's another few years of falling tax after, because companies
rearrange their decks and
absolutely, they're very good at rearranging their affairs to suggest that, hey, no, we weren't really making the money you thought we were making, and it's all been loss making, or it's all been R&D, or it's all been whatever it is that we need to classify it as to bring our tax rate down. That's what we'll do.
Yep.
And so there's that. Yeah, it's not just a one-off.
There's a long tail of as it all sort of slowly.
There's another couple of years as tax advisors, get stuck into it.
Get paid very well to avoid some or mitigate some tax. Fair enough.
Yeah.
Okay, and into the cash.
Final one. Yeah. So just this one's what we're showing here is the price to cash flow level. So these give you a better indication, and that's sort of showing that again that it's quite high in terms of the valuations. We're sort of roughly around the peaks we hit in the pre-financial crisis. And so, I think that's probably not a bad indicator of where we're sitting. Is that I think net from all these ones, we're expensive, but it's not horrendously expensive. But it's certainly on the upper end. And with bonds being so expensive, the question this is was always the Fed's intention. We want to push people into risky assets.
Sure.
This is what we end up with is an expensive market and nowhere else to put your money.
Yep. Okay. Does this have any effect on things like buybacks as well? Yeah,
I think the thing with buybacks versus dividends is it's important to note that from the point of view of an investor, it doesn't really make too much difference. So as long as the cash is going out of the company, if they're giving it back to shareholders as a dividend, or if they're
buying their own stock and pushing up the investor's stock,
the net effect is basically the same.
Okay.
So if you had a 5% dividend and the stock price stays the same and that's all you're getting, that's great. If they weren't paying same company wasn't paying any dividend, buying back 5% of its shares, then the total value of the company doesn't change, but there's 5% less shareholders, so your share price goes up by 5%.
Okay.
And so you end up with the same return, just different, delivered by a different mechanism. And that is that point about we are expecting with the US, they're now bringing back all this money, and they've changed the tax rules so that they can companies with foreign operations can bring back all this money into the US. and we're expecting most of that to end up back in buybacks, dividends, paying down a bit of debt, all
Yep.
that type of stuff. And so, so for a company that's sitting there, though, the paying down debt's probably not going to. There'll be a few over indebted ones that will do that, but most of the company's going to be doing buybacks and paying high dividends,
strengthening up the balance sheet and
because
just, getting back into it.
Interest rates are low.
Yep.
Some of these companies can borrow at 1 or 2%, or
basis points.
And so,
small stuff.
if you're a company trying to, I've got to deliver to shareholders, I don't know, a 10% return, say, or thereabouts, whereas my debt is only going to be 2 or 3% for some of these big guys. It's a no-brainer. Yep, I'll gear up a little bit and give the money back to shareholders.
Certainly presents itself as a bit of a tailwind for share prices going forward, that's for sure. Interesting graph, this one. So we've overlaid long-term interest rates in the red over PE, or the price-earnings ratio, in the blue. Yeah.
Now, this is a cyclically adjusted price.
Okay.
One. So the trick with this one is, so we spoke about before how the last 12 months of earnings, the number's quite volatile because you get write-downs and things like that. So what this does is this takes a 10-year average of those numbers.
Okay.
But then it says, well, the profit I had from 10 years ago in an inflation, I need to adjust that for inflation because that's lower than, $100 10 years ago is worth whatever, $120 today.
Sure.
Once you gross up for inflation or whatever there it is. So it adjusts all the numbers for inflation, takes an average, and then compares it and looks over a longer time period. And what you can very clearly see from here is there's a couple of peaks in terms of in terms of interest rates, and as interest rates are peaking, this ratio is very low for stocks. So basically, stocks are cheap when interest rates are high.
Okay.
When interest rates are low, stocks, not always, but stocks, when interest rates are low, you find stocks can be more expensive. And it's basically just a relative argument in terms of saying, well, if I can only earn 2% on bonds or 1% on bonds, then stocks become more attractive, and so I'm happy to pay a bit more for stocks.
Absolutely.
And what it is showing, though, is on these measures, and this is just for the US, but it's showing that stocks are very expensive on this basis. Now, this argument needs to come back to going, well, our 10th year ago did have some pretty negative numbers in it, so it'll be slightly better once that rolls off over the next year.
Okay.
But also, it was all those comments I had about lower taxes, lower interest rates, higher margins. So if those things are structurally higher, so if interest rates are now structurally lower than they used to be, if tax is structurally lower than it used to be,
Yep.
if margins are structurally higher than they used to be, then you can justify some higher margins.
Yep.
If you think those things are all reverting back to the mean, then this is like a massive sell signal.
Yeah, this is a warning signal. Yeah, gotcha.
Yeah, that's right.
Okay.
And for my take is, look, I think some of those will come back, but I think we're a long, long way away from most of those. Tax, for example, swinging back, or interest rates, I think will start coming back, but I don't think we're going anywhere near to the levels we were, and start coming back globally.
Yep.
Not in Australia. I think Australia's still got a bit to go down, and then from so the valuations are, again, I think this one probably overstates it, but I think it is worth noting that depending upon what measure you use, things can either look really, really expensive, or just a little bit expensive. There's nothing out there that's saying stocks are. There's no good argument to say stocks are fairly valued or cheap.
And I guess the other thing too, just looking at those long-term interest rates, and obviously you've got there's a number of adjustments in here, but you have a look at some of those higher sort of periods in the 80s, etc. When they're up in the double digits, and you sort of think to yourself now, well, what's the potential of interest rates, ever being 6%, given the amount of debt that's sitting out there, let alone 12. I guess it pays homage to the fact that this sort of lower for longer, I use the term again, is there to continue. So then lies the question of the price earnings ratio. So we'll use that as a segue into quite an interesting. This is probably one of my more favourite little bits of information that you generate. But maybe if you just give us a little run through of what we're actually looking at here, and then what lies beneath.
Yes, I've got a table of all the 12-month forward price to earnings ratios for each area of the world, between the world, US, Eurozone, Europe, ex-Eurozone, Japan, Australia, and emerging markets. And then I break it out into there's about 20 odd subsectors. And this is where the point with all of this is, there's the old economist joke that if you're if your head's in the oven and your feet are in the
fridge.
freezer, on average you're the right temperature.
Yeah,
so
gotcha.
Saying, well, in investing, it's not always the same. And you look at these ones like technology services. So on this chart, it's sort of showing that the world PE is about 15 times, and technology services is sort of closer to almost 25 times. And that's your Facebooks and those types of
all your hot stocks at the moment, essentially pulling the market up.
That's right. And so the question is where within this, so there are pockets of value. I mean, you can see that consumer durables there at 11 times. That's chock-a-block full of some car manufacturers.
Okay.
And a few others where there's concerns about are these good businesses in the long term, and can they make a decent return, or are they at cyclical highs, or have they got what are the headwinds coming into the industries and things like that. Finance sector's quite on quite low PEs as well, but there's a whole new topic on that one. And then you sort of dig through some of the others, communications, utilities. There's those types of infrastructure type stocks within there. There's a bunch of resource stocks in there, and the question about what the outlook is for that. But yeah, I guess what it is and by region, it's not the same either. There are regions where you can find
that's another area that you sort of find fascinating, isn't it? That you've got these little pockets of highly priced sectors in individual markets, and Australia's certainly responsible for a few of those.
It's got its fair share, certainly, of those. So one part, I guess. So that's I guess what I'm trying to get to is you've got your average. Now you've got your what's available there, and there are opportunities else out there. There's not, in aggregate, no, there's not. But if you're digging in and trying to find individual stocks and individual regions, there are regions where you can find value. And then to take that sort of inception, so to speak, one dream deeper.
Yep, sure.
Is that one of those? Their retail trade, so the second highest measure, 21 times, and then you sort of break that open and you go, well, yeah, retail trade looks like it's expensive, but when you dig into it, it's got internet retail trading at 120 times.
Wow.
And the rest of the sectors.
Some of the parts are just bumbling along in reasonably priced territory.
Yeah, that's right.
Yep.
So half the markets at a normal rates, and drugstore chains are actually quite cheap. And so within that, so it's that sort of extra level, and the reason why, and that internet retail, actually, if you broke that one step further, is that sort of trading on about 40 times if you exclude Amazon.
Yeah, okay.
And Amazon's like a massive, massive part of this whole market. So you've got Amazon trading on thousands of times PE because it's got a high price and it just doesn't make any earnings.
Yep.
And then you've got the rest of the market, and there's a bunch of stocks in there that are actually very, very cheap. There's a number of retailers you can find out there below 10 times earnings.
Wow.
Which
yep.
So 30-something% discount to the world average, and a lot of those are priced very cheap because they think they're going to get eaten by
Amazon effect.
Yeah. But so you need to be. It's not just a blanket rush out and buy anything that's cheap, but you do need to look into the value and things like that. But I guess the overall message is, it's not the averages hide what's going on underneath.
Absolutely.
And it doesn't, the fact that you can see these things. So, in the whole sector trading at 21 times, if you took Amazon out, then you're talking more like 16 or 17 times.
Yeah, and it's amazing, isn't it? And it just shows you, as you said earlier, that the average is not the rule, really, is it? It's the sum of the parts that you really need to peel back and have a look at to find value, essentially.
Absolutely.
Okay, very good. So we'll finish off with our broad overview of our predictions for the future and our summary. So we'll jump into nothing is cheap. I think it's been a pretty common theme throughout our presentation.
Yeah, that's right. So there's central banks have been flooding the market with liquidity, trying to get people out of safe assets and into riskier assets and get economic growth going. And to the extent that things are no longer cheap, they have been successful in terms of that. They haven't been very successful in terms of getting the growth, but in terms of chasing people out of safe assets, you can give them a tick, job done.
Yep.
Bonds are extraordinarily expensive, and it is worth just every now and again taking a step back and saying, German bonds, 5-year bonds trading at negative yield, so buying something and saying for the next 5 years I'm going to lose money. And I'm happy to take that as a deal.
Yep.
To get security is Yeah,
Staggering.
Extraordinary.
Yep.
Yeah.
Yep.
Stocks are sort of in inverted commas. I'm saying just expensive. They're not horrendously. They're not extraordinarily expensive. You can find some measures where you say that they're very, very high and the peaks. I think there are enough caveats and there is enough changes within that. And once you start digging through the levels, you certainly couldn't find an argument to say they were cheap. But there are, I think, as a broad rule to say they are expensive.
But like anything, I guess, and this is where the analysis comes in. It's finding the diamonds in the rough, so to speak. And this is just going back to that Amazon comparison that you had there, where if you've got the ability in your analysis to remove out a couple of those big heavy hitters that are dragging everything up and making everything look like you just wouldn't even bother looking down. You're going down that sector. Yeah. You'll find potentially there's something there for us.
Absolutely, yeah. If you bought a retail sector ETF in the US, you've basically got 50% Amazon trading on 1,000 times PE, and then a whole bunch of
a couple
couple
of small ones. Yeah.
And so if you can sort of be a bit more selective about what you're choosing, then it gives you that. It gives you the scope, and that's that. Yeah, as you said, the averages on everything, and in the end, the idea of an asset allocation is if we're allocating between cash, which is around the world paying effectively zero. We're in Australia, we're very lucky. We get a little bit higher than zero, but not much.
Sure.
Bonds, which are extraordinarily expensive, and stocks, which are the only ones left. There is timing issues about when markets are high and low and where we expect, but the stocks aren't at a level now where you'd be saying don't buy any of them. We're quite cautious, but there's still value there, and still if we can see scenarios where Trump boom plays out for another 18 months, and we get this decent growth come through, and if we get some trade reconciliation between China and the US, then it could be off to the races. And so we don't want to be too overexposed for those, but you don't want to miss out. You don't want to be seeing 0% getting no earnings for the next 2 years on the back of being overly risk averse.
Sure, and I guess once again, and a topic for another conversation, but we've spoken a lot about the valuation today, but then it comes into the quality overlay as well to make sure that the companies you're finding, whilst they might be cheap, have still got a strong backing and a good tailwind there as well.
Absolutely, and that's where you see certainly over the last few months in the volatility, some of the stocks that were like your Amazons or your Facebooks or Teslas that were the most overvalued and trading on the highest multiples, they were the ones that got hit the most in terms of as concerns come out about them, you find they give up, their earnings drop back a little bit, and because they're trading on 1,000 times PE or in Facebooks and Teslas, well, Tesla's an infinite number, but Facebook might be 30-something times, a small change in the earnings outlook makes a big difference to the share price.
A lot of hot money moving in and out. Okay, fantastic. All right, well, look, thanks very much for that. And that was a fascinating deep dive into global valuations. Thanks very much, Damien, for your time and your good words there.
Thanks, Tim.
So if you'd like to know more, obviously, we'll roll into a little bit about Nucleus Wealth, how you can invest with us and what we do, and we'll take it from there.
Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment. To ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about. and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com.
And coming up next week, same bat time, same bat channel, we have our next instalment of Nucleus Insights, which we've entitled Australia, the Export Economy. We'll be doing a bit of a deep dive, a bit of a look at the exposures that we have to our export economy and our resources sector, looking at iron ore, oil. We'll probably touch on some gas. David's coming in, hopefully for that one. So we'll see David there, and so you can join myself, Damien and David, talking about how exposed our Australian economy is to some upcoming headwinds in our resources sector. Feel free to log in and jot down your name at proton.nucleuswealth.com for that one. And of course, we will be shooting that live, so feel free to jump in with any questions for the live Q&A. And finally, of course, Matthew, our communications expert, will be sending out, as always, our survey. If you'd like to fill that out, gives us a bit of gives you an opportunity rather to review us and see how we've gone today. But also, feel free to drop in there any topics that you'd like to hear about going forward. We're always happy to take some feedback and put together something for you. So that's us for today. Thanks for tuning in, and we look forward to catching you at the next one. Cheers.